Past performance is no guarantee of future results. Content is offered for information purposes only. Unless stated otherwise, any and all individuals participating in the video are third parties that include both professional investors and individual investors who may not be licensed or certified by any institute or regulatory body. Unless stated otherwise, the views or opinions expressed may not reflect those of Seeking Alpha as a whole. The accuracy and completeness of content shared cannot be guaranteed. Seeking Alpha does not take account of your objectives or financial situation and does not offer any personalized investment advice. Seeking Alpha is not a licensed securities dealer, broker, U.S. investment advisor, or investment bank. Hey everyone, Daniel Snyder here from Seeking Alpha. Welcome back to another episode of ETF Spotlight. Now, this week's episode is looking into the world of high income and more specifically, those business development funds that everybody in our audience, I know I've hosted many webinars and you've always been asking our guests about this specific area. Everybody looks at the yield and they go, whoa, 11%, 12% yield. Like that's really cool. So we reached out today to one of the Seeking Alpha analysts, Julia Ostian, to come on here today and talk to us about the BIZD ETF. Julia, it's great to have you on the show. I want to kind of kick things off, if you will. For the people that may not be aware of BDCs, what they are, can you kind of give us that high profile look and then we can start to dive a little bit deeper?
Yeah, sure. So first of all, thank you so much for inviting me. I am really happy to talk about BDCs today because I feel like it's one of those parts of the market that somehow both extremely misunderstood, but also very attractive for the high yields, as you've mentioned. So investors seeking about 10% annual return have a limited number of instruments and sectors they can turn to, and BDCs naturally come up in any conversation, basically for income-focused investors who are seeking high yield. And not only that individual companies in this space provide a high yield, but also some of the ETFs. And this is why I feel like this is a particularly interesting area to take a look at because, well, of course, we know of some of the companies that provide 15, 17, maybe even more percent, right, yield. But ETFs in general, funds, they usually don't yield as high. So BDCs definitely is one of the sectors for this. And the area in general, I would say, is not really complicated. I really like looking at it because it's pretty much straightforward. If you understand the credit, you would most likely enjoy digging up into BDCs. And in general, I would say this is like a hybrid between a lender or even a bank, a private equity fund, and maybe even a venture capital to some extent. And basically the business model is that BDCs lend money to private, small and mid-sized businesses that cannot for some reason get traditional loan. And usually it happens at floating rates. And because these loans are very expensive, the income is very high. Now, by law, business development companies should basically divide the income they get, like REITs, for example, and to transfer them to the shareholders in the form of the dividends. So this is the reason why the dividend yield is so high. So I saw some of the people saying, could it happen that the dividend will be cut to a strong extent? Most likely not. If the business is fine, if the income is there, the dividend will stay relatively high. So another thing that is actually important to note is that because BDCs lend money to small and mid-sized businesses that cannot get, for some reasons, money from other places, they have pretty high, let's say, percentage of write-downs. And this is something investors should definitely note before breaking down this sector. So I would say up to 1.5% at a fair value would be a perfectly healthy. If we go about 2%, it would mean that the management probably does something not really well. As for the income-focused investors, BDCs maybe not the most attractive option because they are usually taxed as ordinary income. And this basically means that they can be taxed pretty heavily in regular brokerage account. So this is why the US investors usually prefer holding it inside IRAs or 401ks. But I'm not from the US. And of course, if some of our listeners are not from the US, they would need to check their tax advisor for this specific.
Yeah. So let me jump in and summarize this real quick. So you're talking about the people that can't go to the JP Morgans, the Goldman Sachs, the Morgan Stanleys and go get traditional loans. So they're turning to these BDCs, which to get their loans, but it's a higher interest rate, right? More risk, potentially more reward, but also probably more volatility, more bankruptcies as you're talking about there as well. So instead of going to an Ares Capital or Blue Owl, like some of the more prominent names and just investing there, we're talking about this BIZD VanEck BDC Income ETF. So why the ETF approach? Is that mainly just to diversify the risk? Is there something specific about this ETF that makes sense for investors? What's the take here?
Well, first of all, depending on who you are as an investor, of course, you could go company by company and pick up individual names and break them down and follow them closely. But first of all, I would find this overwhelming, especially as for an investor that is not professionally into investing, right? If you are a person that does something else and just wants to put your money somewhere, I would say actually diving deep into BDCs would be unnecessary. Like, it's my personal opinion, because of course I am interested in this space. I am breaking it down. But for example, I am not an income-focused investor and I don't have a dividend portfolio. My husband does, and he prefers picking up an ETF. He doesn't choose each specific company, although he had been investing for over 15 years now. But he still finds it's just too much for him to go into every company, and you actually need to follow the decisions of the management, how the NAV is holding, how they're performing, what about the write-downs. And basically, there are a lot of things that you need to take into consideration when investing company to company. So for this reason, you have an ETF, and this is, in my opinion, an amazing way to invest in BDCs, because I don't assume that there is an investor that will put 90% of his portfolio in BDCs. Of course, you are picking REITs, BDCs, maybe some closed-end funds, maybe like whatever other instruments, and BDCs are being one of them. So you are picking an ETF, let's say BIZD, that I've broken down on Seeking Alpha. This is VanEck BDC Income ETF, and you just stick to it. And this gives you the exposure to pretty much every company that you could have picked on the market yourself. And maybe it wouldn't be as, let's say, productive. Maybe it wouldn't be as yielding as it could have been. But on the other hand, you get basically an index that tracks all of the BDCs, and you don't have to actually worry about this too much.
Yeah, you had referenced BIZD as the S&P 500 of the BDC world, which I thought was pretty interesting. And we'll dive into another ETF you mentioned in just a moment. But I wanted to go back because earlier in the conversation, you talked about how these loans have floating rates. And we're in the middle of an interest rate cutting cycle right now. I mean, it's the beginning of December right now. All eyes are on the Fed. If interest rates continue to get cut in the future, not only this month, but going into 2026, how are these funds going to be able to react and still produce returns for the investors?
So first of all, in my opinion, this area of BDCs has been oversold, definitely for the fears of the rate cuts. And I will explain in a moment why do I think so. But in general, I really think that income-focused investors often forget that they're in there for the dividend. Because if you're in there for the dividend, and if the dividend yield falls, there is basically no reason for you to pull out of your position, even if the stock price drops 5%, 7%. If you take a look at for example, BIZD or PBDC or some of the other ETFs from BDC companies, the stock level returned relatively fast, I would say in a span of like a month and a half, to the same level it's been before. The dividend, of course, wasn't cut. And right now with a lower rate environment, this is possible. And some of the BDCs indeed will cut the dividend. And BIZD has actually already cut the dividend beforehand as an ETF. But still, I already said that in my opinion, it's all like the reaction was overblown for a couple of reasons. So first of all, let's imagine that the secured overnight financing rate goes down 25 basis points. So basically what it means for a regular business development company is that their loans will go down by about 25 basis points or even less. Now, imagine it will happen 3 or 5 times, whatever people say will happen, right, with the rate cuts. This will compress BDC's top line, let's say maybe 75 to 100, maybe 125 points. So it basically means that at the end of this thing, you will get a 1% lower distribution of the dividend, which of course is unfortunate. I cannot say like definitely an investor that wanted to get 10% yield wouldn't be happy to get at the end 9% yield. But at the end of the day, it's still like relatively high yield for the market. Let's say if most of the BDCs will cut their base dividend by 1%, you will still be in the range of 8 to 12%, which is, in my opinion, is great rates anyway, great returns anyway. And also, let's not forget that there is a special dividend in many cases. And for companies, for example, like Maine, most likely they will not cut even the base dividend. They will just take back the special dividend, which is basically a surplus on their income because the rates were really high. BDCs were making more than they expected that they will make. So they basically gave special dividends on the surplus of the incomes that they had. Now, most likely they will cut those special dividends, but the base maybe will not be cut at all for some of them. For the ETFs, most likely we will see a base cut of, as I already said, I don't expect to see a base cut of more than 1 or 1.5%. And still, in my opinion, right now, this is definitely not the time to pull back from and to put out of the positions on BDCs yet. There are, of course, some of the conditions of the market when I would want to rotate my holdings from BDCs and BDC ETFs, but rate cuts isn't one of them. And if you actually choosing a big funds with good management, they know how to operate in different conditions and in different environments.
Julia, I would love to talk to you. So we've obviously been talking about the VanEck BDC, the BIZD ETF, but you had mentioned earlier, and also you've been writing about this in the last few weeks about Putnam's BDC Income ETF, which is ticker symbol PBDC. Now, you were highlighting a certain couple different metrics, right? Such as the total return is better. This might be more for active investors versus a BIZD, which is more passive. Can you kind of break down why you kind of favor this PBDC on the return base when it looks like a lot of the holdings are the same and the expense ratios kind of look high on both of them?
Okay, so I would say that I favor one of them, but I actually gave a buy rating for both of them. For what I actually got many questions from people, and they're actually not agreeing with my decision because they're like, well, but PBDC actually returns more. And there is a pretty big difference between two funds. So let's jump quickly back to BIZD because I think we forgot to mention that, first of all, this is not an actively managed fund. There is no management that actually sits and waits for something to happen to rotate the positions. This is basically an index that tracks the performance of all of the BDCs. And actually, so you just understand how huge it is, to be included in BIZD, I think the BDC should have a market cap of about $150 million, which isn't much at all, and some certain minimum average daily trading volume, which also isn't high. So basically, inside of BIZD, you have, if I'm not mistaken, 33 BDCs. And you will be heavily invested in the main ones like RS Capital, Blue Owl, of course, Main Street, Golub, etc. And these four take a third of this entire ETF. So you will be basically dependent on these large, well-established names on one hand. But on the other hand, I don't see this as particularly a negative thing because, first of all, they are well managed. They are, for a reason, the biggest funds. Second of all, BIZD as a fund has been around for over 10 years, since 2013. It had seen different cycles. It's seen COVID, zero rates, rate hikes, liquidity squeezes, basically anything you can think of. This fund has already been into. And I think it gives many investors like this feeling of not needing, to panic and to actually do something actively, because they can actually go take a look at past performance and assume that everything will be fine from now on. And the difference of BIZD and PBDC is that PBDC is actively managed, as I already said. And there is, of course, a downside, because PBDC has been around only since 2022, and we haven't seen it in COVID, for example. But at the same time, it's not as new. So we've seen it, for example, this April, and it recovered pretty nicely. So overall, if you take a look at BIZD and PBDC, BIZD is much larger. They have over $1 billion in assets under management, which is a lot. You will not find an ETF as large. PBDC is much smaller. It's like maybe 7 times smaller, but it had been yielding better. So basically, since the inception, PBDC has outperformed BIZD by around 15%. On a total return basis, meaning price appreciation together with the dividend paid but not reinvested. And it's not yearly, of course, 15%. It's overall in 3 years of time. And of course, PBDC is actively managed, so you will see pretty much similar names inside PBDC as well as BIZD, but especially in the core group. Of course, there is Main, of course, there is Aris, of course, there is Golub. But first of all, the positioning is very different and the weights are very different. And there are basically decisions that are being actively made. And I really like it because people that are working there have over 20, 30 years of experience with credit and with BDCs. So I personally trust the management of PBDC, and I view the fact that this is an actively managed fund only as a positive. And actually the performance also showed the fact that they are actively managed.
Yeah, excellent point there, Julia. Points definitely need to be heard. Management matters, obviously higher risk, high reward, as we talked about earlier, and market fluctuations will matter as well. But thank you so much for the time today. Let's go ahead and wrap it up there. Everyone, Julia Ostian, go follow her on Seeking Alpha here. She's constantly writing great articles within this space and others as well. And we're going to link to some of those articles beneath this video. So take some time to read them today, drop into the comments, engage with her. Excellent conversation. That's all I've got to say. This is definitely a space that needs more focus. So thank you so much for the time today. Everyone, this has been another great episode of ETF Spotlight, and we'll see you again here next week.